Hi, personal finance gang. I hope you're all doing well out there as we continue our investment segment of the course. Today's topic is going to be bonds, and we'll start off by talking about what bonds are, and then important in considering bond purchases, we want to know who issues bonds because bonds are categorized generally in large part by the issuer of the bonds. And then we'll talk about some of the risks of bonds. We're hitting just the high points of bonds in this discussion. So there's a lot more to bonds than what we're going to see, and we're not going to get into the mathematical valuation of bonds and such, just the high points of bonds. And some of you out there may be saying, hey, I have no interest in buying individual bonds. Well, to be honest, neither do I. I don't own any individual bonds, but I actually do have a fair amount of money in bonds, but I have that indirectly through mutual funds and ETFs, which will be next week's topic. And again, even if you don't plan to own individual bonds, which you may not know what they are yet, but even if you don't plan to own individual bonds, odds are you will have bonds in your futures, maybe indirectly. So first, what is a bond? I think we touched on this a little bit last week, gave the definition, but here it is again, because these are two definitions I want you to know. What is a bond? Well, if you buy a bond, you are lending money. Okay, so you are a lender if you are buying a bond. The issuer of a bond is borrowing money, but if you as an investor buy a bond, you are lending money to the issuer of the bond. So if you buy a corporate bond, you are lending a corporation like Apple Computer, you are lending them money. If you buy a U.S. government bond, you are lending the U.S. government money. So, bond, you buy a bond, you're lending money. If you buy company stock, company common stock, like if you just go and you buy stock in IBM, you are now part owner of the company. So, stock gives you ownership interest. A bond, you are just lending money. With bonds are debt instruments. The issuer of the bond promises to pay you, the holder of the bond, periodic interest and to pay the face value of the bond at maturity. So that's what you get when you buy a bond. You get a promise of interest payments and a promise of some face value of the bond at maturity. With most bonds, the interest is paid twice per year, and then you get your face value when the bond matures. So you get one final bigger payment when the bond matures and a last interest payment. Now, with bonds, if the issuer of a bond misses an interest payment, well, an interest payment on a bond is a contractual obligation. So missing an interest payment means lawyers are likely to be involved. And so that can lead to, will lead to legal issues if you miss an interest payment. So they have a contractual obligation to make those. If you buy stock, we're going to contrast bonds and stock a little bit here. If you buy common stock, the cash payments that the companies make to their stockholders or shareholders are called dividends. Now, many companies do make dividend payments, but there is no contractual obligation to do so. So if the company decides not to pay dividends anymore, that is not a legal issue. Okay. So big difference there. Bonds, your interest payments are going to be made, or there's going to be lawyers involved. Stock, dividends, if a company's been paying dividends, they don't have to continue. Odds are they will and will want to, but they don't have to continue those payments. With bonds, bonds are longer term debt securities, and they generally have maturities, original maturities of 10 to 30 years. So that means they promise to pay back that final amount in 10 years to 30 years. Okay, so that's the date of the last payment is called the maturity date. With stock, there is no set maturity date, and the stock can go on forever. So you could buy Apple computer stock and leave that to your great-great-grandchildren, and those great-great-grandchildren could leave the Apple stock to their great-great-grandchildren. So the company Apple and the stock itself could go on indefinitely, but bonds have, most bonds have set maturity dates. There have been a few that don't, but those are very rare. There have been some 50-year bonds or 100-year bonds, but those are rare as well. So most bonds promise to pay in 10 to 30 years. Well, you're going, geez, who's going to buy a 100-year bond? Well, you don't have to hold it the whole 100 years, obviously. You can sell it at any time or pass it on to your heirs, like your Apple computer stock. So that's one difference between bonds and stock is maturity dates. Now with bonds, you aren't an owner, so you don't get a say in the operation of the business for the most part. Stockholders do get some say in the running of the business, and they do that primarily through the election of the board of directors. So if they're not happy with the direction of the company, they can vote in a new board of directors. Bondholders, again, they don't get to say for the most part, unless maybe we're in some bankruptcy type situation. So which is riskier, if you buy and make an investment in bonds or if you make an investment in stock? Well, stock is much riskier than bonds. In fact, should the company be forced into bankruptcy for whatever reason, the bondholders and everybody else, creditor-wise, must get paid first before the stockholders get anything. So the the bondholders have much less risk than stockholders. So stock is riskier than bonds. And, okay, so now to the issuers of bonds, and this relates to, we buy bonds based on the issuer because that tells us a lot about the risk and other things. So who are the biggest issuers of bonds? Well, the number one issuer of bonds on the planet is the U.S. government, so the U.S. Treasury. So that's one category of bonds is U.S. Treasury debt. Then we have under that agencies of the U.S. government, and then we have state and local governments, we have U.S. corporations, and then we've got, well, foreign bonds. We can also buy, we can buy bonds in foreign governments or foreign companies, etc. We're going to touch on each of these first four categories briefly coming up. So we've got Treasury or government issued debt. We already saw, it's categorized, the U.S. government's debt is categorized by time horizon. So we've got Treasury bills that mature in a year or less, Treasury notes, which mature original maturities of 2 to 10 years, and then Treasury bonds over 10 years. So most of those Treasury bonds are issued with 30-year maturities. We've already talked about Treasury bills back when we talked about places for your safe money. So Treasury bills have original maturities of a year or less, and they don't make periodic interest payments like you would get with Treasury bonds. Instead, you buy them at a discount. So you might buy a $1,000 Treasury bill right now and pay $973 for it. And what you'd collect is at maturity, you get $1,000. The difference between what you paid for it and what you collected would be your interest on the Treasury bill. So no periodic interest payments, just one payment at maturity, and the difference between what you paid and what you collect is your interest. Treasury notes and bonds both pay the periodic interest twice a year, so you get 2 interest payments per year, and then you get your face value at maturity. So if you had a $1,000 bond that was paying $20 of interest a year, you get 2 $10 payments during the year, every year. And then on your final year, the last payment would come with one more interest payment, and then the face value of the bond as well, the $1,000. Now, I was going to pull this up, but I'll tell you just right now, save us a click here. Longer-term U.S. debt is paying about 1% right now. Not much. Pretty low. Interest rates in general have been very low since 2008, 2009. Interest rates right now on U.S. government debt, in fact, driven down some by the reason we're having this class online instead of face-to-face, the bleeping coronavirus. Many investors sold stock because it was risky, a lot of risk going on, and they put their money instead in something they considered very safe. So they bought U.S. Treasury debt, and when a lot of people buy it, it drives the price up. And as we'll see briefly later on, that drove interest rates for the debt down. So interest rates have been pretty darn low, and they're for Treasury debt at or near historic low levels right now because people buying safety, putting their money where they think it's safe, and that drove, everybody wants it, that drove the price up and the rates down. Oh, and I closed this. Let me make sure I get this back open. This is a scary site, if it pops open here. The USAdebtclock.com. This is the, they said the U.S. Treasury is the biggest borrower on the planet. I think we may have looked at this earlier, but here it is way back when in this semester. Here it is. I'm popping back to it, and we're driving on up towards 24 trillion. And actually soon we're going to be shooting way above 24 trillion because we've got trillions. I've lost track of how many trillions in stimulus money we're going to have. I'm going to watch here on the clock. We just went up to 82 million here at the end of this. This is 23 trillion and there's 82 million at the end. And I'm going to tell you, we're going to get to another million. So you see roughly how long it takes for the government to get an additional $1 million in debt. It's not long. As I've been chattering away, we're almost there to, yeah, we're going to click on up to the next million. So it's up to 83 million at the end there. But we're going to have trillions of dollars in stimulus money as a result of the bleeping coronavirus. COVID-19. And anyway, so this is going to be, I'm predicting, well, you look back here in a year and this will be 28 trillion or so. Last year the government spent about $1 trillion more than they took in, and this year it's going to blow that sky high with the stimulus money. Your share of the debt right now, about 72,000. That's just this. That doesn't count unfunded Social Security, Medicare, and more. Don't worry about that right now. That would just be too depressing. Okay, but biggest debtor on the planet, the U.S. government. That's pretty depressing. Okay, but are Treasury securities considered risky? Are they easy to buy and sell? Still got that debt clock looking at me over on the side. I got to turn that off. So are they easy to buy and sell? Well, still, U.S. government debt is considered to be default risk-free, and I'll say I buy that for the short to intermediate term. Long term, hey, we'll be 30 trillion before too long and heading for who knows what in debt. Eventually, somebody might want some of that back. But but right now, we still consider them safe. So investors still flock to this because they considered it safe debt. And the government can of course, tax us, tax corporations more, and print more money. But anyway, so for right now, considered to be default risk-free. Easy to buy and sell. These are the most commonly traded securities on the planet, so they're very liquid. So easy to buy and sell at the current price. No worries there. And you can go to treasurydirect.gov and buy these with as little as $100. Tax consequences of buying Treasury securities. So, nice thing about these, well, you do pay federal income tax. That's not the nice thing. The nice thing is no state or local income tax. That doesn't matter to us at all in Florida. But if you lived in a high tax state like New York or California or Illinois or someplace like that, you wouldn't have to pay federal income tax, and that would come in handy. Okay. Agency bonds. These are we have some, think of like the Post Service, and then we've got student loan marketing, and then we've got some places, some government agencies designed to make it easier to get a home for most people. Those are government agencies, quasi-guaranteed. They're de facto guaranteed by the U.S. government, but they don't have an official guarantee on their debt. Also, they're less liquid, so there's not as much trading activity going on. Makes selling a little harder, or you lose a little more, pay a little more transaction costs to do that. So this makes them a tad bit riskier. So they pay a little, and because of that, they pay a little bit higher return. So government-sponsored agencies. Now, there are state and local governments all over the country. I got 80,000 plus by my count here. Many of these are also borrowing money, so they issue bonds. Most of those bonds are owned by individuals, and we'll talk about why that is coming up. So how risky are municipal bonds? As a whole, generally low risk, but some of there are definitely some that are much riskier than others. So you got to check on their credit ratings. More on that later. So then we'll see yields can vary a lot. That means the returns they pay, the interest they pay. The riskier it is, the higher the return you're going to demand. Now, what kind of breaks do you get from municipal bonds? Now, this is a nice one here. No federal income tax owed on interest income from these bonds. State income tax, it depends. For example, if you were an Alabama citizen and bought an Alabama state bond, Alabama might not charge you any state income tax on their bond. But if you were an Alabama citizen and bought a Georgia state bond, Alabama might charge you income tax on that. But the big thing here, federal income tax, keep accidentally clicking that. I didn't click that time. I'm removing my hand. So the federal income tax there is a big one to avoid. Okay, and because of this, mostly municipal bonds are bought by individuals in higher income tax brackets. Remember that the U.S. federal income tax is progressive. The more you make, the higher the tax rate you have. So not paying a federal income tax is a bigger advantage for people in high tax brackets. So again, that's why most municipal bonds are owned by high tax individuals. Municipal bonds know that they have a tax advantage, so they can actually pay a lower return than corporate bonds of similar risk and still be attractive. That's because investors focus on after-tax returns. And we'll see an example of why this is right now. Okay, so suppose you're in the 25% federal marginal tax bracket, and you've got a choice between a corporate bond that pays 10% and a municipal bond that pays 8%. What should you do? Well, so let's say you buy the corporate bond, it pays 10%. Well, the government's going to take a fourth of that income from you in taxes. So you'd end up earning basically 7.5%. If you bought the municipal bond, there's no federal income tax, so you get to keep it all. You actually earn 8%. So in this case, this investor earns a net of 8% with the muni bond versus 7.5% with the corporate bond. So definitely they should buy the municipal bond. If, on the other hand, this was a choice faced by a poor college student who's just getting out and isn't going to owe any federal income tax this year, well, the corporate bond would pay them 10%. They don't owe any federal income tax. They would end up getting 10%. With the municipal bond, there's no tax advantage to them. They'd get 8%. So the starving student just starting out who isn't going to owe federal income tax would be better off with the corporate bond. Well, let's take a break right here, and we'll pick up with some more bond stuff in the next part.